Okay, now we're gonna go through our non-current liabilities. As we all know, non-current liabilities is also an obligations towards external parties, but it is not due within 1 year, right? And the obligation also derives from prior transaction. Okay, the first long-term notes, the first non-current liabilities we're going to go through today is the long-term notes payable. The characteristic for long-term notes payable is more or less the same like the short-term notes payable. Okay, it is still a promissory note by the company. Okay, so when you reach the maturity date, you need to repay the principal, okay, the amount that you borrowed, together with the interest on the specific date. Okay, this specific date means that is on the maturity date. Okay, but the only difference between short-term notes payable and long-term notes payable is the purpose of issuing the notes payable. Okay, so notes payable, as we all know, if it's a long-term notes payable, that means the tenure must be more than 1 year. And why do we issue long-term notes payable? Because normally the issuance of the notes payable is for the purpose of purchasing a fixed asset. Okay, whereas for short-term notes payable, the purpose of issuing the notes payable is to obtain more cash, right? Okay, so we go through the journal entries to record the notes payable. Okay, so if we were to issue the notes payable, okay, actually the journal entry serves the same purpose as we are buying or purchasing the fixed asset. So since we are issuing the notes payable to purchase fixed asset, that is why we're going to debit fixed asset and we are going to credit the notes payable, because as we all know, the purpose of issuing the notes payable, the long-term notes payable, is to accommodate the purchase for the fixed asset. Okay, but you must remember, every year there's a interest expense that we need to pay, or we need to declare. Okay, we are going to make the payments for the interest expense once we reach the maturity date. So for the time being, before we reach the maturity date, we need to declare the interest expense for every year once the accounting period is closing. So the amount that we declared as the interest expense will be accumulated in your interest payable, because at that point you haven't made any payments yet. So that is why we will credit the amount into our interest payable. Okay, so to record the interest expense, we will debit interest expense and we will credit interest payable. Okay, all right, so once you reach the maturity date, okay, let's say the maturity date is on the 31st of December. Okay, so this is the maturity date. So I am surrendering the notes payable, so I'll be debiting the notes payable. At the same time, I need to pay the interest expense. Okay, this is for the current year. Okay, because the account is not closed yet. Okay, it's just towards the closing date, so you will be paying the interest expense on the spot. That means you will declare that as your interest expense, and then at the same time you need to pay for the backdated interest expense that is already accumulated in your interest payable. So this three amount will be paid during the maturity date. Okay, so now let us look at the example so that we will have better understanding of the situation. Okay, given in example 8, the company has purchased a machine. Okay, the machine is purchased at the price of 25,000. Okay, and the purchase was made on 1st of January 2012. Okay, and the payments for this asset was made with two methods. Okay, they segregate the payments into two sections. The first section is 5,000, that is paid by check, and the balance of it, that is the remaining, is paid by signing notes payable with a tenure of 5 years. Okay, so once you issued the notes payable, that means you need to pay the principal together with the interest. So the interest rate for 1 year is 8%. Okay, and the company closes its accounts every year on 31st of December. So you need to prepare journal entries to record the transaction in 2012. So in this question, the transaction that revolves in liabilities for 2012, okay, one is when you issue the notes payable on 1st of January 2012, and the second one is when you close your account on the 31st of December and you need to declare the interest expense for this particular notes payable on the closing date, because as we all know, 31st December is actually the adjusting date for all the closing entries. Okay, so we need to adjust all the expenses and the revenues for the current year. Okay, so how do I record the purchase of the asset? Okay, the first thing I need to do is I will debit the machine, because that's a purchase of a machine, and the payments for this machine is made by issuing a notes payable with the amount of 20,000 and paying by check with the amount of 5,000 ringgit. So this is actually to purchase asset or to issue a notes payable. Okay, so this will be the first entry on 2012. And when you reach 31st of December on the same year, you need to declare the interest. Okay, so how much is the interest for 1 year? So as we are given in the question earlier, the interest rate is 8%. Okay, and the principal is 20,000. So that means every year I need to pay the amount of 1,600. But please bear in mind, because this is notes payable, so that 1,600 will only be paid during maturity date when you surrender your notes payable. So that means this amount won't be paid on the closing date of 2012, but that amount will be accumulated in your interest payable. Okay, so how do I record the transaction? Okay, so here you will debit. Okay, so here right, I will debit the interest expense with the amount of 1,600, and since there won't be any payments yet, so that is a liability to the company, so we will credit interest payable. Okay, so this entry will be done every year until you reach the maturity date. Okay, so you'll be doing this entry for the interest expense to record the interest expense on 2012, 2013, 2014 and 2015. Okay, do I need to record the same entry on 2016? No, because on 31st of December 2016 I'll be settling my notes payable, so the payments will be made on the spot. All right, so on the 31st of December in the year 2016, that is the maturity date. Okay, so as you can see here, this is actually your maturity date. Okay, Okay, so this is your maturity date, 31st of December, and this is for the year 2016. Okay, okay, and then what do we need to record on this day? All right, so you will debit notes payable, okay, and you need to declare and pay the interest for 2016, so we will debit interest expense. Okay, so this is actually 8% from 20,000. Okay, this is for the year 2016. Okay, and what happened down here for interest payable, this is actually 1,600. Okay, multiply by 4, which is from the year 2012, 2013, 2014 and 2015. So these three amount here will be paid on 31st of December 2016. So the amount that we need to pay on that day is 28,000. Okay, so this is how you record the payments for the notes payable together with the interest, and the interest is accumulated for 4 years, and since that previous 4 years are all backdated amount, so that's why it is accumulated in your interest payable. Whereas for this interest expense, that is actually for the current year, so you need to pay that as well. Okay, so actually the amount of the interest that we need to pay is 20,000. Okay, hold on a second. Okay, actually the amount that you need to pay is 20,000. Okay, all right. 20,000. Okay, times 8% per year, and since the tenure is 5 years, that means you'll multiply with 5. So you'll get the amount of 8,000 ringgit. Okay, so this 8,000 ringgit is in the form of interest expense 1,600 and interest payable 6,400. Okay, all right.